right now, the narrative remains the same. I mean, the market's being ruled by skepticism, and that actually is serving as a really good backdrop or a backstop to the market, keeping it from having big, reoccurrences of going down, as it were. There seems to be a lot of buying of VIX futures, gold and silver. People are keeping one eye to the Fed, looking at the yield curve, and it seems like that's the current narrative that we're stuck in right now. People very complacent over yield and grabbing for everything, keeping the stock market as high as it is.
I'll come back to the market in just a moment there, Larry, but just on those oil prices, because it's these comments from Saudi Arabia's energy minister around these informal talks being held potentially in late September. The market really seems to be rewarding this rhetoric. But as we know, last time this happened back in April at Doha, it really failed without any sort of agreement. Are you at all optimistic about an agreement emerging in the coming months?
No. I have no optimism over an agreement over the next couple of months. And it's strange because the wording that was used was very similar to what we heard just a few months ago. I think it just did a lot for risk sentiment. And even if there was a production freeze, we have to keep in mind that Russia, Iraq, Iran are both near the height of production anyway. There's really not a whole lot they can do. Saudi Arabia, that's a whole different story, but they typically tail off their production this time of year for seasonal reasons. So it's amazing what it's done to sentiment. And as we've seen going back to January, the oil price continues to under and overshoot in both directions. And right now it seems to be trading right where it needs to be, given the fact that we are going towards a balanced market at the end of this year.
Well, let's speak the broader market, because it does seem to be continuing to grind higher, sort of recently reaching these record highs, although stalling, of course, in the latest session there, but edging ever closer to that 2200 mark. How do you think the market is likely to sort of navigate around these levels where we're sitting at the moment?
Yeah, I think the market's pricing a lot of it in right now, and it's really, on one hand, really good to see. I think the market is pricing in a stable but low growth range, and that's for oil, that's for the equity market, that's for yields. But beyond all that, I think we're all very complacent. Every market day that goes by, we haven't seen a 1% move in the stock market since non-farm payrolls came out on August the 5th. And we're seeing volatility in all asset classes trading at 1 year, if not 2 year lows. So a lot of complacency going on. A lot of people probably just waiting for Jackson Hole and then bigger news in September when we have all the central bank meetings.
Yeah, OK, so a couple of upcoming catalysts, I guess, to watch there for US equities. But as you say, I mean, the theme really dominating the moment is this hunt for yield. And with these low rates expected for longer, it's probably hard to say when another alternative to equities will come back into play. So in light of that, is there any sort of telling how much further this multiple expansion will go? Because already the market's looking fairly expensive.
Yeah, no, if you look just at multiples, yes, the market does seem to be expensive, and there seems to be an overconfidence in the earnings per share number for next year, which is $130. At a 17 times multiple, that would get us to 2,200 in the S&P 500, and we're 20 points away from that. But there's nothing to say that the multiple couldn't go to 17.5. I mean, multiples overshoot and undershoot as well. There is another line of thinking that doesn't look at multiples as much, but looks more at return on equity. And if you look at the stock market in general with return on equity, then it's a harder case to make that the stock market's overvalued, because some of these issues are returning a lot on equity.
Obviously, despite that steep rise in equities, investors and those retail investors in particular, they seem to be a little bit sceptical, don't they, Larry? And this seems to be showing up in that VIX ETF buying. Is that what you're taking out of it? Is that one of the signs of this scepticism?
Yeah, exactly. I think, the skepticism is acting as a very good backstop to the market. There isn't a whole lot of volume in the stock market. Institutional investors have tailed down their holdings in the past 3 or 4 weeks. that's a great recipe for a market to continue to grind higher, and it's something we've seen ever since 2013 at least, where the market kind of rallies before the data says so. But at this point, we're at a pretty high multiple. We're trading, 17, near 17 times. There isn't a lot of margin for error at this point. It's not that I think the market's going to have a huge correction. I just don't like investing at things, in my mind, that are fully valued.
How much do you think the equity rally, I mean, you mentioned Jackson Hole there and some of the upcoming sort of catalysts potentially for the market, but how much do you think this rally is being driven by the upcoming presidential election? Because I know that a lot of people out there, including yourself, are sort of watching this escalating promise of fiscal stimulus to rebuild the nation's infrastructure. How much of it is being driven by the upcoming elections?
Yeah, that's very interesting. And, from the American point of view is that we're all very complacent, just thinking that it's going to be status quo for the next 4 years, a split House and Senate and a Democratic president. And so more of the status quo. However, that's what we all thought this time back in 2008 before the Lehman debacle in September, that there was going to be a split House and Senate, and that clearly wasn't the case. So you bring up an excellent point also with infrastructure spending. It's something that there's a lot of momentum for, and that's something with rates being as low as they are, it makes tons of sense for the government to do that. And so if you want to see rates rally, that's one way to get in the rally, to start fiscal spending on big projects like that.